But our next guest questions the relevance of the rating cuts at this point in the cycle. Gerard Cassidy is head of U.S. Bank Equity Strategy at RBC Capital Markets. Gerard, always great to speak with you. So if clients are calling you today and you're saying, you know, this Moody's thing is off base, it's late to the game, et cetera, which banks are you saying you should buy at this point based on the sell-off?
I think, Melissa, what we have to look at is, you know, the track record of these companies through a full cycle. And we're certainly going to see banks have higher credit losses as credit issues normalize. We all know that the credit picture for the banks was amazingly strong coming out of the pandemic, and the numbers were unsustainably low in terms of credit losses, and they're starting to normalize now, but we think they're very manageable. And so as a result, when you see a sell-off today based upon the Moody's news, which I'm not saying it's wrong, the timing seems very odd. It's kind of late to the game, as you pointed out, or you mentioned. And I would say that if we really are going to see the Fed reach its terminal rate for Fed funds, let's say in September, and there is no hard landing in the economy next year, then the banks are in really good shape. And so banks like M&T, which was one of the names that was downgraded today, has a proven track record of being one of the best managers through a credit cycle. And that would be certainly a name to look to own. Another regional that was put on watch was U.S. Bancorp, another proven bank that through the cycles really has proven they can manage through these credit cycles. So I think it's kind of late to the game. I like that expression you used, Melissa.
In the framework of your recommendations, Gerard, are you forecasting a recession, a soft landing recession in 2024? Because that's the Moody's scenario. Are you saying no recession at this point?
Yes. From the start of the year, we've always been in the camp that the economy was slowing down to a mild recession, and we're still in that camp. Even though the cross currents today are incredible. You look at some of the hard data, like the leading economic indicators, you look at the inverted yield curve, and you have to say to yourself, you know, we should be in a recession. But then you see the real GDP numbers that we just produced for the second quarter, and we all saw the growth that the economy had. The employment picture, we all know, is still very strong. So we're taking the view that it's still, economically speaking, over the next 12 months, it's definitely a slowdown. And then the question is, do we technically go into a recession for 2 consecutive quarters of slight negative growth? That's possible. And we would, again, as the credit normalizes, the banks will be able to manage through that at this point in our view.
Gerard, Bono and Ison here. Thanks so much for sharing your thoughts with us. Quick question. Do you have any idea of what might have been the catalyst for the timing of this release? You mentioned that was a bit awkward. Do you think it had anything to do with U.S. sovereign debt downgrades, or am I off the mark here?
Yeah, no, you know, you're bringing up the real point. You know, why now? You know, right after the Silicon Valley debacle in March, they put a bunch of banks on, you know, the watch list in April. And I would say that was really the time. But, you know, it's, you know, and I don't criticize the, you know, the rating agencies. It's a tough job they have. But, you know, they really are trying to get out in front of this. So ideally, you know, this type of action should have been taken last November or December. And because we all thought, and, you know, the economy possibly could slow down. So I don't really think it had much to do with what went on with the U.S. government debt issue. But that is, as we go forward, we all know that is going to be an increasing issue for this economy.